All right, let's talk about the massive financial shift hitting all of us right now, the 2026 borrowing shock. If you've even thought about buying a house, financing a car, or taking out a business loan recently, you've definitely noticed that borrowing money has suddenly gotten ridiculously expensive. Today, we're diving straight into the data to decode exactly why this is happening. We're going to break down the heavy hitting macroeconomic forces driving these costs up, and more importantly, what this all means for your wallet. So let's get right to it. Why is your mortgage getting so much more expensive in 2026? It's a question hitting right at home. We constantly hear these big, intimidating terms like global finance, central bank policies, and sovereign debt. But the reality, those massive, invisible forces are landing right on your front doorstep. When the cost to borrow money changes on a global scale, it takes a direct hit on your personal finances. Whether you're renewing a mortgage, getting an auto loan, or just paying down a credit card, you are, whether you realize it or not, a player in the global bond market. And nothing proves this quite like one absolutely shocking number, 5.3%. By August 2026, the 30-year US Treasury yield literally hit 5.3%. To put that into perspective for you, that is the highest level we've seen since all the way back in 2007. And right alongside it, the 10-year yield was hovering around 4.7%. Guys, this isn't just a tiny market blip, this is a financial earthquake. When the yield on US government debt hits a 2-decade high, alarm bells start ringing in every financial institution on the planet. But to really grasp the impact of that 5.3%, we've got to understand the mechanics behind it. Which brings us to rates versus yields, the big difference. There is a massive misconception out there that we absolutely need to clear up. The news constantly treats interest rates and treasury yields like they're the exact same thing. They're not. On one side, we have the interest rate. This is the benchmark set by the Federal Reserve. The Fed uses this rate like a giant thermostat to cool down inflation or heat up economic growth. It's a set number. But on the exact opposite side, we have the treasury yield. When the US government needs to borrow cash, they issue a treasury bond. Investors buy that bond, and the return they get, that's the yield. Here is the key takeaway. The Fed does not set the yield. The yield is driven entirely by free market investors who are buying and selling those bonds every single second. Simply put, the Fed dictates the rate, but the market decides the yield. So, knowing that, let's look at the domino effect, the 5 massive reasons yields are rising. Domino number 1 starts with a number so huge it's almost hard to wrap your head around. $40 trillion. The US government debt has officially blown past the $40 trillion mark. Now remember, when the government needs cash to cover its expenses and service this absolute mountain of debt, it has to borrow. To do that, they flood the market with brand new treasury bonds. It's just basic supply and demand, right? Because there's this massive oversupply of bonds hitting the market, the government is essentially forced to offer higher yields just to attract buyers. Moving on to reason number 2, the return of inflation fears. Think about the investors buying these government bonds. They are locking away their cash for a long time. We're talking 10, 20, even 30 years. Their absolute worst enemy is inflation because it eats away at the future value of their money. Right now, with wildly volatile oil prices and rising geopolitical tensions, there's this growing fear that inflation isn't actually dead yet. If investors even suspect that inflation is going to stick around, they are going to demand higher yields today to protect the future value of their investments. Then we have reason number 3, intense uncertainty at the Federal Reserve. If there's one thing markets completely despise, it is uncertainty. Currently, there is a massive debate tearing through the investor community about exactly what the Fed is going to do next with interest rates. Because nobody can agree on whether the Fed will keep rates high for the long haul or finally start cutting them, long-term treasury yields are under a ton of pressure. Investors are straight up demanding a risk premium simply because they have no clue what the central bank's next move is. Now, reason number 4 is one that might actually surprise you: the AI and data center borrowing boom. You're probably thinking, wait, what does artificial intelligence have to do with government bond yields? Well, major tech companies are currently borrowing colossal amounts of cash to build out massive AI infrastructure and data centers. That means highly attractive corporate debt is directly competing with US Treasuries for the exact same pool of investor money. When tech giants are out there offering fantastic returns on their corporate bonds, the US Treasury literally has to push its own yields higher just to stay competitive. And finally, reason number 5, global bond market pressures. The US is not on an island here. Other major economies around the world are facing their own rising government debt and fiscal issues, which is driving bond yields up globally. For international investors, this means they have options. If an investor can get a super safe, high yield from another major economy, the US has to match or beat that return to get their money. It is a fierce global competition for capital. So you've got this wild mix: $40 trillion in debt, inflation fears, Fed uncertainty, the AI borrowing boom, and intense global pressure. So, what does this all mean for you? Let's look at the fallout and the actual impact on your wallet. When treasury yields skyrocket like this, the cost to borrow money shoots up across the board. Mortgages and home loans become significantly more expensive, which literally prices some buyers entirely out of the market. Auto loans get pricier, meaning your monthly car payment takes a hit. Everyday credit just costs more. For businesses, taking on new corporate debt to expand or hire new people becomes a massive financial burden, which can actually slow down the broader economy. And for the stock market, high bond yields offer a really attractive risk-free alternative to equities, which puts a lot of downward pressure on stock prices. But it's not all doom or gloom. If you're a saver, this environment is actually a rare, huge win. Those high yields translate directly into much better returns on fixed income investments and high yield savings accounts. Now, let's talk about the US Treasury's reaction to all of this. To try and calm this highly strained environment down, the US Treasury has actually been forced to step in. Most notably, they are ramping up buybacks of long-term bonds. Basically, by stepping up as a buyer of its own older debt, the Treasury is injecting some desperately needed liquidity straight into the bond market. This move really helps support the overall demand for Treasury securities, making sure the market keeps functioning smoothly even under the crushing weight of these high yields. It's a strategic move to keep this borrowing shock from spiraling into a full-blown financial crisis. Let's bring it all together for the bottom line. You take historically high government borrowing, you add in lingering inflation fears, you mix in total uncertainty at the Federal Reserve, and you top it off with massive corporate borrowing for the AI boom. When you add all that up, the mathematical reality is that Treasury yields are going to stay under intense pressure. The biggest takeaway from all of this data is crystal clear. This specific combination of massive economic forces basically guarantees that everyday borrowing costs are going to stay elevated for a long, long time. We've unpacked exactly how this domino effect works and why financing your life is so expensive right now. But, the world of global finance never actually stops moving. So I want to leave you with this one really provocative question to think about. With US borrowing costs staying this high and the global competition for capital getting fiercer by the minute, where are global investors going to move their money next? Are they going to just keep parking it in these high-yielding US treasuries? Or are they going to start hunting for new opportunities in emerging markets and alternative assets? It's definitely something to keep your eye on. Thanks for hanging out and exploring this with us today.